Okay, well, my next guest says, aim high, but think small. He says small caps are poised to outperform after keeping pace with the broader market this year. Satya Pradhuman is founder and CEO of Cirrus Research. And Satya, great to have you back with us.
Great, thanks, good morning.
And before we get to small cap picks, you say the big risk for next year is staying in the big caps.
Absolutely. When we look out over the next 12, 18 months, the credit cycle as we know it will continue to unlock. Just about every time we've looked at this, you'll see as credit gets easier, smaller companies appreciate a lot more. They've doubled the S&P in periods where you've seen credit spreads go from 700 bips down to, like, say, 400, 500. So at the end of the day, credit money is really the sort of fuel for these small companies.
And you're fully confident that that will loosen?
Yeah, I think we'll continue to see it. It shouldn't occur in a nice, steady step fashion, but I think it's going to continue to move in that direction.
Satya, it's a compelling argument, but at the same time, you've got big names in the Dow like Exxon and Walmart and AT&T, which have underperformed, lagged the rest of the market this year. They're a lot cheaper than the S&P. As an average investor, why would I bother wasting my time trying to find a small cap that there's no research on when I can buy these big names at cheap valuations?
I think you make a good case for some selective names. It gets a little tricky, though, if you're trying to navigate from one name to the next. The other side of it is, I think, as an individual investor, these are riskier assets. Even if I like them a lot more over the next 12, 18 months, they should probably be thought of in a portfolio as opposed to just one name at a time. So it's definitely more of a serious investor space, I think.
Well, let's say you actually want to play the thing. You can go out and buy the IWM, right, the ETF, which is for small cap. That's up about 27%, a little more than the S&P. Is that the best way to do it? Just kind of index yourself to some small caps?
I don't think so. I mean, I think if you're going to get paid for running active money, if you're going to bring something to the table, usually you want to apply that to where it's less efficiently priced. So going back to some of the big names you've mentioned, when you've got 20 or 30 analysts covering each of those names, you got to be pretty smart to bring alpha to the table.
Excess return.
So as a result, I do think active fund managers make a lot of sense here because they actually go through controlling for risk a bit, but they're also looking more carefully at these risk these specific names.
Yeah, you give your money to someone else and let them run it rather than do it yourself.
So where would that be then, Satya?
Well, I mean, I think when we look at the smaller cap landscape, we continue to see real opportunities in some of the defensive groups like the food companies per se. We are seeing a huge smattering of some technology industries that look very good in the work. Exception to the rule could be the semiconductor space, which looks very rich at this point. They bottomed, I think, since last November. Then they've, on average, I think they're up 60, 70% already.
Okay. Satya, we'll have to leave it there, but thanks so much for stopping by. Satya Pradhuman, CEO of Cirrus Research.